Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the video is how to transfer your income to your children's and to pay 0% tax in the US 2025. So basically we will discuss that how to hire your child as an employee and save on the taxes. So, hiring your child as an employee can be a strategic move that benefits both your family and your business. Not only does it provide your child with valuable work experience, but it can also offer significant tax advantages. By employing your child, you may be able to reduce your taxable income as paid to your child can be deducted as a business expense. Additionally, if your child is under 18 and work for a sole proprietorship or a partnership owned solely by a child's parent, their wages may not be subject to social security and Medicare taxes. However, it's crucial to ensure that the employment arrangement is the legitimate. So a financial advisor can help determine if hiring a child as an employee makes sense for your personal tax situation and a small business needs. So here we will discuss that family employees and taxes. Tax regulation offers attractive tax benefits to owners of small businesses who hire their children to work for their family firm. The child earnings are also likely to qualify for favorable tax treatment. As a small business owner, you can pay each child you hire up to $15,000 in 2025 without them owing any federal income tax. That's because this amount matches the standard deduction for single filers. Your business also gets to deduct your child's wages as a business expense, so you can't just hand your kid cash and claim it as a deduction. However, the IRS requires you to follow the rules to make the most of this tax play. So to properly hire your child and unlock tax savings, keep these guidelines in mind. Give them an actual job. Your child must perform necessary work related to your business. Personal tasks like mowing your lawn don't count. So make sure the work suits the child as well. Paying a 16-year-old to sweep out the warehouse is credible, but claiming a kindergartner is keeping the business's book is not. So the pay reasonable wages, compensate your child fairly as you would any non-relative employee. The IRS may flag excessive pay. So follow the employment laws. Treat your child like any other employee when it comes to tax withholding forms filling and more. Keep good records. Carefully document hours worked, pay received, and taxes paid. Consider tax implication. Your child pay may or may not be subject to the Social Security, Medicare, or unemployment taxes based on their age and your business structure. So as long as you closely follow the rules, the IRS let your business deduct your child's pay. Your child, meanwhile, can earn up to the standard deduction tax free. What is the next step? Planning for your taxes can be overwhelming. We recommend speaking with a financial advisor. This free tool will match you with the vetted advisors who serve your area. Here's how it works: answer a few easy questions so we can find a match. Our tool matches you with vetted fiduciary advisors who can help you on the path towards achieving your financial goals. It only takes a few minutes. Check the advisor's profile, have an introductory call on the phone or the introduction in person, and choose to work with hiring your child in action. An example may clarify how this could work in practice. Say you run a small social media consulting business as a sole proprietorship. You decide to hire your 16-year-old daughter to manage your company's Instagram account for $12 per hour. She works 10 hours per week for 12 weeks during this summer, earning $12,000 total. You pay her wages and get to deduct $1,200 on your business tax return. You withhold income tax from her paychecks, but that pay is not subject to Social Security or Medicare taxes since she is under 18. At tax time, your daughter files her tax return. If you don't claim her as a dependent, she can take the standard deduction for single filers. If she is a dependent for tax purpose, she can claim a standard deduction of $12,050 on her earned income plus $400 up to full standard deduction for single filers. This protects her $1200 in wages from any federal income tax. By properly hiring your minor child, you save 7.65% in payroll taxes, social security, and Medicare on $1,200 that comes to the 91.80 dollars. Your child meanwhile saves 10% of the $1,200 or $120 in federal income taxes. Similarly, the more she earns from the working for your business, the greater her tax saving is up to standard deduction amount. So, what are the restrictions on hiring a child? Hiring a child to work in your business can be beneficial arrangement for both the child and the employer, but it is crucial to understand the legal restrictions involved. However, hiring child can be financial winner. This is not a solution suitable for every taxpayer. If you are considering it, keep these limitations in mind. You need self-employment or business income to qualify for the deductions. If wouldn't work for wage earners, your child must be under age 18 for the wage to be exempt from Social Security and Medicare taxes. Once your child reaches age 21, you have to pay federal unemployment taxes on their wages. The IRS may flag high pay rates for children as unreasonable if they exceed the normal or norm of for their duties. So, you and your children must follow all documentation and reporting requirements. Failing to do so could nullify the tax benefits and possibly incur the IRS penalties. The IRS is not likely to give you much leeway if you violate these rules. However, the requirements are not particularly burdensome and tax savings can be substantial if everything is done correctly. So, hiring your child as an employee can be a strategic move not only benefits your family business but also offers potential tax savings. By employing your children, you can shift income from a higher tax bracket to a lower one, effectively reducing your overall tax liability. This approach is particularly advantageous if your child is under 18, as a security and Medicare taxes when working for a parent owned sole proprietorship or partnership. Additionally, paying your child a reasonable wage for their work allows them to contribute to a Roth IRA, setting a stage for their financial future. So, what are the tax planning tips? If you hiring your children seem like something you want to consider, meet them financial advisor to ensure you fully understand the requirements before moving forward. Smart Assets Free tool matches you with vetted financial advisors who serve your area, and you can have a free introductory call with your advisor matches to decide with which one you feel is right for you. So, here we will discuss that can I really reduce income by paying my kids wages for doing a variety of jobs. So, here we will discuss that you can really do so. You can nullify it. You cannot nullify it. You can reduce your income tax by paying your kids wages for doing a variety of jobs. So what is the kiddie tax explained, rules 2024 and 25 thresholds, and how it impacts your family finances. The kiddie tax is a law stipulating how investments and unearned income are treated for minors or full-time college students under 24. Before kiddie tax, parents could save on taxes by putting investment accounts in child's name. Parent would gift stocks and other assets to their children. The income earned on the assets would be taxed at the child's lower income tax rate instead of the parent's higher income tax rate. So the kiddie tax closed this loophole by taxing children's passive income at the higher rate. So history, what is the history of the kiddie tax? The Kiddie tax was created as a part of Tax Reform Act in 1986 to prevent parents from shifting income producing assets into child's name to take advantage of the child's lower tax rate. Under the Kiddie tax, all unearned income above a certain threshold is taxed at the parent's marginal income tax rate instead of the child's tax rate. So the Tax Cuts and the Job Act of 2017 temporarily changed the rules effective with the 2018 tax year, substituting the tax rates that applied to trust and the estates for the parents' tax rate, making the kiddie tax much more expensive for some families. This caused an uproar because of impact on the Gold Star families and scholarships. In response to the backlash, Congress included a provision in the Setting Every Community Up for Retirement Enhancement Act to revert the kiddie tax to the old retroactively for 2025 tax year. The first $1,350 of a child unearned income qualifies for standard deduction. The next $1,350 is taxed at child's income tax rate, and unearned income above $2,700 is taxed at the parents' marginal income tax rate. For 2024, these values were $1,300, and $2,600 respectively. So that is the given amount. Why does a kiddie tax apply to? Who does a kiddie tax apply to? So talking about this concept, the kiddie tax applies to dependent children who are younger than 19 years old or who are full-time students who are between the ages of 19 and 23. Any exception to the kiddie tax is a child with earned income totaling more than half of the cost of their sport. So another exception is for children who file tax returns as married filing jointly. Income from wages, salary, tips, or self-employment is not subject to the kiddie tax. A child's unearned income may include taxable interest, dividends, capital gains, taxable scholarships, income produced by gifts from the grandparents, income produced by custodial accounts under the Uniform Gifts to Minor Act. So how to calculate the kiddie tax for tax year 2024? To calculate the kiddie tax, the first determine the child's taxable income, child's net earned income, the child's net unearned income, and minus child's standard deduction is equal to child's taxable income. For 2024, the first $1,300 of a child's unearned income is tax free, and the next $1,300 is subject to the child's tax rate. Any additional earning above $2,600 are taxed at the child's parents' marginal tax rate. For this year, the child's standard deduction amount is greater of $1,300 or the sum of $400 plus the child's unearned income. If the child can be claimed as a dependent. Otherwise, the standard deduction for a single filer is $13,850. For example, if a dependent child has no earned income and $3,500 of unearned income, and $900 would be subject to the kiddie tax and is taxed at their parents' marginal federal income. So this is 2024 federal income tax brackets, from 10% to 37%. This is 2025 federal income tax bracket from 10% to 37%. Families with children who have unearned income that is subject to the Kiddie tax must file IRS Form 8615 with their federal tax return. A separate tax return must be filed for children in the certain cases are 5 to 9 plan earnings subject to the Kiddie tax. So, interest earned on the 5 to 9 plans and custodial 5 to 9 plan account is not subject to the Kiddie tax. 5 to 9 plan are investment accounts designed to help individuals save for college. Contributions are made with after tax dollars, and any interest earned on the investment grow tax deferred. Distributions are completely tax free when the funds are used to pay for qualified higher education expenses. Investment earnings in other custodial accounts, however, are subject to the Kiddie tax. Custodial accounts used for the college savings may be converted to the custodial 5 to 9 plan accounts to take advantage of the tax benefits. Saving held in custodial 5 to 9 plan accounts also have less of an impact on a student's need based financial aid eligibility than traditional custodial account. So what is the Kiddie tax? Capital gains: when someone receives a profit or an increase from an investment, it is considered a capital gain. Any capital gain from an investment can be taxed as either a short term or a long term capital gain. When a minor or full-time college student under 24 receive investments income, it must be reported. Either the child can report the capital gains on on their tax return, or the gains can be reported on the parents' return. So, what is the IRS reveal in this? Family tax credits for IRS changes that can save your money. So, if we discuss about, millions of working families rely on family tax credits like the child tax credit CTC to support household bills like food, housing, childcare, and the education. Claiming these and other federal tax credits and deductions like the adoption credits and earned income tax credits can lower your tax liability or the increase your fund refund amount. So some family tax credits like CTC, SC, and adoption tax credits were enhanced under President Donald Trump's so-called one big beautiful bill. That means some families could receive a bigger tax refund next year. Here's what you need to know about your family tax credits in 2025 and how they've changed under the Trump administration's newly. First of all, child tax credit increases in 2025. Trump's big beautiful bill raises the um, federal child tax credit from $2,000 to 2002 $200 per qualifying child on your 2025 tax return. Without the mayor, the maximum credit would have reverted to the $1,000 in 2026. So the maximum refundable portion is worth $1,700 in 2025. That's the amount you can claim for the tax returns you generally file in 2026. There's one caveat: to claim the CTC, the child and taxpayers must have a social security number. Then comes the enhanced adoption tax credit in 2025. The federal adoption tax credit for 2025 tax year, taxes generally filed in 2026, is worth up to $17,280. The tax benefits for adoption include tax credits for qualified adoption expenses paid to adopt a child, and an exclusion from income, and the employer provided adoption assistance. Then comes the third point: earned income tax credits, EITC. And the earned income tax credit is a refundable tax credit that is available for people with the and earned income below a certain threshold. Then the fourth point is enhanced child and dependent care tax credit. For example, he remained unchanged for more than 10 years, that is until Trump administration enhanced the tax bracket under the newly enacted OBB. So that was the topic. Hope this will be beneficial for you. So do subscribe the channel for such more informational and helpful videos. Thank you.